Hello and welcome back. First of all, allow me to thank you for your support. Looks like the channel has been growing really nicely over the past few weeks, and I'm surprised myself that the channel is enjoying that growth. We're doing better and better, and people seem to like the videos. I really love hearing from you. So any comments that you make, I love reading those. And if you haven't joined, you may want to take a look at the Discord channel that I have created for this channel where we're discussing all sorts of things about investing. And you may want to join because you get the latest updates of the channel. Plus, you're going to be the first to know and get access to the software tool that I'm currently working on. So if you haven't subscribed in the channel, if you haven't joined Discord, you may want to take a look. Now, I really understand that people feel weird when there are downturns in the market, as right now. And I have made a video in this channel about a day ago or so, in which I'm discussing why you should actually embrace these kinds of downturns and look to add to your positions or add new positions to your portfolio. Because you have heard the expression that time in the market beats timing the market, and that's kind of true and false at the same time. Now, they have kind of lied a little bit to you because it does make sense that, yeah, you don't really want to time the market in the sense that you always want to keep investing in the market. However, it's generally speaking a very good idea to not invest in the stock market when we have all-time highs. So previously we used to have all-time highs for quite some time, like the market was going higher and higher and higher every day. Now, when you get a downturn of like 10% or a 15% or even more than that, that's a golden opportunity. And this is where myself, I look to add a lot of stocks to my portfolio. That's how I like doing it. When I start seeing some downturn, that's a substantial downturn, I always like to buy good quality stocks and companies really. When their value in terms of the stock value has gone down, yet their business is doing great. So I just wanted to mention that because it's very important for investing and not being fearful about the current situation in the market. These things happen, they happen a lot, these downturns, and they will keep happening. And maybe there is also a crash, who knows, like a real crash. But eventually everything will go back to normal. So make sure that you don't invest with money that you need, and you'll be fine. And invest in good companies, of course. So today we're going to take a look at AirBNB after this little speech that I gave. We're going to take a look at AirBNB, a company that's enjoying a little bit of hype lately. And it's been going down, obviously, with the markets and going down generally speaking, like the past year has lost 20%. Very interesting. When I just see this screen over here, the first thing that pops into my mind is that the company's, the stock actually is overvalued. And the way I deduce that is basically just by quickly looking at the price to book ratio, which is very high, and the P ratio, which is currently a minus, meaning that the company is losing money, and projected to be positive but very high a little bit later next year. So we obviously want to examine a few more things, but these first few metrics are very important. Let's take a look at the outstanding shares here. Company seems to be issuing more shares to fund operations, so they are diluting investors quite heavily actually over here. Very heavily. This is like 1 year over here, so that's not great. Company is not paying any dividends, so let's take a look at the income statement of the company. Try to deduce some information about what the company is doing financially. So enjoying growth, generally speaking. 2020 was a bad year, I'm assuming, because of the virus. That would only make sense. So I'm willing to basically exclude this year over here. So the company seems to be enjoying about a 30 to 40% growth normally. Even now it's actually 60 because it actually kind of compensates for the previous year, I'm pretty sure. Now, operating income here is massively in the minus. Interesting. And I'm assuming that the net income is going to be heavily, like companies losing billions over here. That's not great. Well, this kind of high growth companies could be losing money for a long time and be fine, but we want to make sure that they can actually compensate for that in the next few years, achieve profitability. And also we want to make sure that we're not buying the company at a very high price based on what the company is projected to do. So let's take a look at the total equity. I'm interested here. So total equity seems to be increasing, but Why is it increasing? I mean, the company is losing money, right? Look at this line, additional paid-in capital. So it's investors. This actually comes from money paid from investors to purchase stock. So you saw earlier that the company is having more outstanding shares, right? We just examined that. And so that means that they are diluting investors, issuing more shares. People buy those shares and they fund the company with more money. So companies do that because it's cheaper to fund fund your expenses through stockholders than actually getting loans, of course. But it's bad for investors because it's diluting them. So that's not great for an investor, especially that high over here, like 8 billion and 10 billion. I guess they kind of wanted to make some money for while the pandemic was going on, but that's not great. Cash flow over here. Let's see the operational cash flow. It is actually positive here, which is a nice sign to see. So at least the company is not losing money from operations. Cash from investing a little bit, and I'm assuming that they won't have positive cash from actually they do. Yeah, so they even have positive cash from financing. I guess it's because of the issuance of common stock, because that counts as loans. They still got some debt as well. Yeah, that makes sense actually because they issued a lot of stock. They do have a lot of uh, positive lines in financing. And financing, in case you are not aware, is basically loans and selling stock, issuing and selling your own stock is what this is about for the most part, or paying dividends. This is what this kind of lines in the cash flow statements depict. Debt, issuance of stock, and dividend payments is for the most part what you are looking at over here. All right, so this is positive, means that there was cash inflow from these operations, but it's generally speaking a negative thing for investors because whether the company got a loan or the company issued stock for investors, unless it's not dividend payments, which is probably okay, it's generally a bad sign here to see that. So take a look at the free cash flow. Yeah, apart from 2020, free cash flow is in the positive at least. And it's actually increasing pretty nicely if you exclude 2019 and 2020, which cannot be very indicative for Airbnb operations, really. So I can safely kind of exclude these years, really. I'm curious to take a look at the solvency, the total debt to equity. It's okay. It's not horrible or anything of that sort. But this has to do a lot with the fact that the company issued a lot of shares. So this is a big factor. If the company got this financing from debt, this would be more than 100% more than likely. If they had to finance this from debt in stock instead of stockholders, this money that they got. So it's an interesting case. I mean, the thing is, if we go back at the cash flow statement, which is always very, very indicative, you will see here that the free cash flow, at best, we can project it to be, let's say, $1 billion a year, at best. And that's probably too much even to project, because it could go down. I mean, we don't have enough data to actually make sure that this is going to be sustained. Even if we put it at $2 billion, a multiple of 20 would make it a $40 billion cap for the company. Right now it's at 90, so it's more than 2 times that amount. So Airbnb is an interesting case of growth as well. I mean, in the income statement, looks like the company is growing, and again, I'm willing to exclude this year because something out of the ordinary happened, the pandemic. This is going to be happening every year. So I think the company will keep increasing its revenues. And so this kind of growth is not negligible, for sure. However, the company is overvalued based on the cash flow that the company is making and the earnings. So what am I doing with this company? So the thing is, I do like Airbnb. I have used the service quite a few times, really. It's very, very nice, a very, very nice service, and I'm pretty sure it's here to stay. I actually expect it to be worse than it is, to tell you the truth. So it's a company that I wouldn't invest in necessarily. I mean, it wouldn't be my first target for sure, but I would keep it in my shortlist. One of the important reasons as well is that it's approaching its all-time lows, really. and you do have a lot of leeway, so there is a lot of room to grow and go back to previous highs, and that kind of matters a lot, because if you exclude the fundamentals, people's psychology matters as well. And so when something is at its lower price, it can eventually fly to its higher price over the years or over the months. It's a matter of people holding the bag. There's a lot of room to grow, and a lot of positivity potentially later, just because we are at a very, very low price compared to where the company has been. So this can play a role in terms of psychology. Yet in terms of the fundamentals of the company, it's not a buy right now for me. However, if it were to drop more and maybe go at a discount of like $100 over here, I could seriously think about getting a little bit and just factor the potential growth that the company will have over the years, because that definitely does matter as well. But right now, I feel that it's a little bit expensive for my taste. That doesn't mean that if somebody buys it, they won't be able to make money out of it. It's possible. However, I really don't like the fact that they are diluting investors so much, and they haven't even gotten to getting debt, instead of getting much debt at least, instead of actually getting money from stockholders by issuing shares. So if they somehow revert to that, eventually they will have to. I'm pretty sure this will potentially grow worse, unless it keeps making money and increases its cash flow, and so which can happen, and then maybe they don't need that much debt, much financing. Maybe it's a little bit unclear, and I don't have enough data to decide for sure. But I think right now I would just stay out of it and just wait for a potential heavy discount, which could actually drive me to buying a little bit of stock and just be okay. I'm factoring growth a little bit here. I know that I'm overpaying, but still factoring growth. And maybe I want to buy at a price of like 100. Maybe. Again, that's a maybe. We can revisit if that happens. But right now, I think I will avoid. So thank you for watching the video. Hope you enjoyed. And if you did like it, you may want to watch the video that I made earlier about the stock market potential crash and what you should be doing in these situations, how you should hedge yourself against the danger. Thanks for watching, and I'll see you soon. Bye bye.